So let me ask you this. What is your money actually doing for you right now, while you sleep, while you work, maybe even while you're relaxing? Look, most of us hear from a young age how important it is to save, right? Tuck money away, a rainy day fund, all that. And, building that saving habit, it's absolutely foundational, great start. But here's the thing, and it's crucial. Just saving it isn't really enough anymore, not in today's world. While having savings is step one, it's only the first step towards real financial security, long-term prosperity.
Precisely. I mean, look around. The cost of everything seems to be going up constantly. And then there's inflation. It's this quiet background noise just eating away at your money's value. So cash that's just sitting in a basic savings account, it's actually losing purchasing power. Over time, that really adds up. If you're dreaming of a comfortable retirement, maybe helping kids with college or just wanting more options, more freedom down the line, well, your money needs to do more. It needs to work harder for you, keep pace, or, ideally, get ahead of those rising costs.
And that's exactly what we want to dive into today. How do you shift your money from just sitting there passively to actively building your future? Think of savings like this. It's your immediate safety net, absolutely essential for emergencies, unexpected bill, job loss, you name it. But for actually building wealth, creating something lasting, investing, that's the tool you need. So how do we get our money off the sidelines and into the game? It kind of points us towards, well, some people call it the eighth wonder of the world, your money's secret superpower, maybe? What is this financial accelerator we're talking about?
Yeah, we're talking about compounding. Simple idea,
Yeah.
really powerful results. Basically, it means you earn returns not just on the money you initially put in,
Yeah.
but also on the gains your investments have already made. So your earnings start earning more earnings. It creates this snowball effect that accelerates over time.
Right, the snowball analogy. Rolling downhill, getting bigger and bigger. But it's not just bigger, is it? It's faster, too. That acceleration is the really interesting part.
Absolutely. Let's make that a bit more concrete. Imagine you invest, say, £200 every single month, consistently. You do that for 20 years. And let's assume, for simplicity, maybe a 5% annual return before tax and fees, obviously. Okay, so you've put in £48,000 over those 2 decades, just adding it up. But with compounding, that pot could grow to something like £82,000.
Wow, that's quite a jump. Almost double what you put in.
Exactly. And now let's stretch it out. Same £200 a month, same 5% return, but for 40 years. Now, your contributions are £96,000. Yeah. But the total value, it could be over £300,000.
Okay, that's staggering.
The real growth, the serious acceleration happens in those later years. That's compounding really kicking in.
And this really highlights the key ingredient, doesn't it? It's not magic, it's time. The longer you let your investments compound, the more potent that effect becomes. It's maybe less about how much you start with initially and more about how long you stay invested letting that money work. It reminds me of that saying, like planting a tree, small seed, small effort up front. But with patience, consistency over decades, you get something really impressive.
That patience is absolutely vital. And it draws a clear line between saving and investing. Savings are about safety, immediate access. They hold their face value pretty much. Investments, though, they're designed to multiply, to build on themselves year after year. That potential for exponential growth is the whole point.
Okay, but let's talk about right now. Interest rates have gone up a bit, haven't they? So saving in cash suddenly feels, well, safer, maybe more appealing. Is it actually enough for the long term, though?
Yeah, that's a really common thought right now. And understandable. Higher rates on savings are definitely better than nothing. But here's the catch. They often still struggle to beat inflation. Think about it. If your savings earn maybe 1%, maybe 2%, but inflation, the rate prices are rising, is 3% or more.
You're losing ground.
You're losing purchasing power every single year. It's like an invisible leak in your financial boat. Now contrast that with investing. If you look at historical data, long term, the UK stock market, for example, has generally delivered returns above inflation. Real returns. Cash. Over those same long periods, it tends to lose value in real terms.
So holding too much cash for the long run.
Yeah.
It's like choosing to walk when there's a high-speed train available.
That's a great way to put it, yeah. Investing is fundamentally your best strategy to try and outpace inflation, to protect your future spending power. When you own shares, you own a piece of actual businesses. As those companies adapt, innovate, maybe raise their prices to cover rising costs, you as an owner can potentially benefit from that growth.
So your money grows with the economy instead of being eroded by it.
Exactly. Investing is really your best defense against that silent thief of inflation.
Okay, so the case for investing seems pretty strong. Compounding, beating inflation. But let's be honest, for a lot of people, making that jump from saving to investing feels big, maybe intimidating. What are the main things holding people back, those sort of mental blocks or myths?
Well, I think the biggest one, hands down, is the idea that investing is only for, the experts, the financial wizards, or people who are already wealthy.
Right. You need a lot of money to start, or you need a finance degree.
And that's just not true anymore, not today. Investing is genuinely accessible now for almost everyone, regardless of your job, your age, your income. There are loads of apps and platforms where you can start small, really small sometimes, like 25 pounds a month, 50 pounds a month. The barrier to entry is, frankly, incredibly low compared to how it used to be.
And you don't need to become a stock market analyst either, right? You don't have to spend hours researching companies.
Absolutely not. That's another part of the myth. Modern investing makes it much simpler. You can use things like ready-made portfolios or simple global tracker funds. Yeah, these funds basically spread your money automatically across hundreds, sometimes thousands, of different companies and even different countries. So it takes away a lot of that pressure to pick individual winners. It makes it much easier, much less stressful.
What about the risk? People worry it's just like gambling, putting your money on the line.
That's another really important distinction to make. Gambling versus investing. Yes, investing involves risk. There's no getting around that. Values can go down as well as up. But it's fundamentally different from gambling. Gambling relies purely on chance, on a speculative outcome.
Right.
Investing, on the other hand, is about owning a piece of real businesses. Companies that make things, provide services, employ people, generate actual value over time. You're participating in economic growth, essentially. Now, markets definitely have their ups and downs. They can be volatile. Sometimes they crash. We've all seen that. But if you look at the long arc of history, major markets have always recovered. They've continued to grow over the long term. The real danger, often, isn't the market fluctuation itself. It's letting fear take over during a downturn, panicking, selling your investments at the bottom.
Locking in those losses.
Exactly.
Yeah.
That's usually far more damaging than just riding out the volatility.
Okay, so if someone's listening and thinking, right, I get it. I want to move from just saving to actually investing. What's the game plan? What are the key principles for building? Well, you called it a financial fortress earlier. How do we build that?
Okay, yeah. There are definitely some core rules or maybe guidelines. First, think long-term, seriously long-term. Investing is generally for money you don't need for at least 5 years, preferably longer. That time frame helps you ride out the inevitable market bumps and lets compounding really do its work.
5 years plus. Got it.
Second, be consistent. Invest regularly, little and often, like that 200 pounds a month example. This approach, sometimes called dollar cost averaging, means you buy more when prices are low and less when they're high. It smooths things out. And remember, time in the market usually beats trying to time the market. Don't try to guess the peaks and troughs. Just stay invested.
Okay. Long-term consistency. What else?
Third, patience and emotional control. This might be the hardest one, but it's like your investing superpower. Don't let headlines or fear or even greed drive your decisions. Make a sensible plan when you're calm, and then stick to it, especially when things get choppy.
Stay the course.
Pretty much. And fourth, absolutely crucial, keep a separate emergency fund. In cash, easily accessible. This is non-negotiable. It's your safety buffer. It stops you having to sell investments at a bad time if life throws you a curveball.
That makes a lot of sense. Build the foundation first.
Okay, you mentioned spreading money around earlier with funds. That brings us to diversification, right? Why is that so important? Why not just back one winning horse, so to speak? Put all your eggs in one basket. The eggs in one basket. Yeah, diversification is key to managing risk. It simply means spreading your money across different types of investments, different companies, different industries, different countries even.
So if one area struggles,
others can potentially balance it out. It reduces the impact if one specific company or sector hits a rough patch. Your whole portfolio isn't reliant on one single thing. And again, this is where investment funds are brilliant, especially for beginners. With one single fund purchase, you can effectively own tiny pieces of hundreds or thousands of companies all over the world. Instant diversification.
takes the legwork out of it.
It really does.
Yeah.
And proper diversification also often means mixing different types of assets, like shares, which aim for growth but can be more volatile, and maybe bonds, which tend to be steadier, more for stability. And across different regions too, UK, US, Europe, Asia.
Yeah.
Getting that mix right, spreading the risk, that's what builds that resilient financial fortress we talked about. It smooths the journey and helps protect your wealth.
Okay, so wrapping this up then. The core message seems to be moving from being a passive saver to becoming an active, engaged investor. It's about taking control, really, empowering your financial future, and as you said, remembering it's a long game, a journey, not a sprint.
Exactly. And, there's that saying, knowledge is useless without action. It's true here. You
Wow.
can read about investing forever, but nothing happens until you actually start. Honestly, the best time to start investing was probably years ago. The second best time, it's right now, today. Every day you wait is literally a day your money isn't potentially growing, isn't compounding for you. So start small if you need to. Set up that regular monthly investment, even if it's just a little. Build the habit. That's the most important part.
So, maybe a final thought for everyone listening. Just picture your life 10 years from now, 20 years, maybe even 40 years. How might those small, consistent steps you could take today with investing, how might they reshape that future reality, allowing your money to actually grow, to provide for you in ways that just saving it, well, it never really could? Thank you for joining us on this deep dive into making your money work harder for you.